Awesome. Well, next individual I want to introduce everybody to, Master Trainer Charlie Finn. And Charlie Finn started trading options in the mid-1970s, and shortly after the CBOE opened, and that's when he started trading. And for the last several years, Charlie's been trading options full-time and recently joined a DTI as a mentor for a short-term options trading room. And I'm excited to have Charlie join us today and share with us his experience and as well as his expertise. So Charlie, I'm going to go ahead and take you off mute and make you presenter as well. And so go ahead and feel free to run whenever you're ready to go.
Okay, here we go. Looks like we're doing great. Yeah, well, I started this off back in 1974. Worked for a little company called Merrill Lynch. CBOE opened, and they had a total of 40 stocks that were traded on the options exchange, and only calls. So we were very limited what we could do. So back then, we couldn't do something like this. We're going to talk today about turning a losing trade into a winning strategy and how we can actually do strategies and all rather than just trades. Now, disclaimer, of course, we always have our usual disclaimer. There are risks involved with any trades, and especially with options. Now, today's lesson, we're going to try to turn a trade into a trading strategy where we can reduce the risk while we're increasing our return. Not a bad way to do things. Now, the lesson is going to be a review of anatomy of turning a Netflix after earnings losing trade into a winning trade. Now, this was just done just in the last month, so it's real live data that we'll be talking about. So remember that it is live data, and past performance doesn't mean anything about future results. Now, Investopedia defines trade as just simply buying or selling a security. That's the way most people do that. They'll just buy or sell. Now, definition of strategy. It's a plan of action designed to achieve an overall goal. And our goal is going to be keep on adding trades to that so that we can't lose. In a trade, you have choices. It's either long, or it's short, or it's an out. That's that simple. You buy a stock, you sell a stock. You buy a future, you sell a future. Or you don't. That's simple. Now, a strategy, you actually put a strategy on if you're doing just a buy or sell a stock. That strategy that you should have is you should have a target price before you ever put the trade on. And you should have a stop price already picked so that you're limiting your risk. That's part of a strategy. Now, additional strategies for stocks and futures are kind of limited. We can hedge with a future or an option. We can hedge stock with a future option. We can pair trades, some of those things, but it's very limited what we can do as far as a more advanced strategy goes with just trading stocks or futures. Now, with options, I always say you have options. Got a lot of different choices here. We have puts, we have calls, we have different strike prices, we have different expiration periods. I'm not going to go into what a put and a call is or spreads because I think we've had enough of that already today. A lot of the presenters went into some very, very detailed and very good information and all on that. I'm going to go back to a trade that we started on Netflix. Now, Netflix is a fairly volatile stock. I think everybody knows that. Now, April the 21st, they were scheduled for their earnings to come out after the market. The stock closed at $384.49, so let's just say $384. Well, they came out with their report, and there's three parts of a report. It's earnings, you have your profit, P&L, which is going to be earnings, and it's going to be revenues. And then the most important part to me really is the guidance for the future. So we had a lot of things that were coming out there, and it looked real good. And what happened overnight, the stock trades, and it went up quite a bit. It opened the next morning at 376. Hey, guys, that's 28 points up above its close. It went at a high as 380, and it came back down a little bit. Well, looking at this and the way that Netflix has worked in the past, I said, okay, so we have a possibility of a higher market here. But I expect it to pull back some. I really do want it to pull back some, but I want to be able to participate if, in fact, it runs up. So rather than putting a full trade on for all of the stuff that we would normally buy or sell and all of our investment, we said, okay, let's take a look at this. We have this thing trading up here at 380, and it's pulled back a little bit. So why don't we say put on half of a trade in the area where we are today and watch tomorrow and see what happens, and then we can adjust our trades and put on our full load. So we made those assumptions. It's going to be longer term up, possibly a very short term move down. We want to participate if it moved up, and we want to limit our risk if it moved down. Well, that's a lot of different things to try to do. So what did we do? First thing, turned around and sold May week 2s. Now, these are weekly options, and the way that the CBOE defines these, it looks at them in weeks. So it'll say like week 1, May 1 is the first Friday of the month, May 2 is the second Friday, then May, which is the normal expiration, is the third Friday, and then so forth. So what we did was sell a spread. Now, spreads people talked about earlier, but all it is very simple. We sold a 352.5, 355 put spread. Now, what it means is we sold a 355 put. That brought in cash for us. But we didn't want to have unlimited risk on the downside, so we bought some 352.5 puts. So now we're saying, hey, we've got a defined risk trade. We received a premium. Now, as long as it stays above 355, that premium goes into our pocket. 100% of it goes right into our pocket, 75 cents. Well, that's not much, 75 cents. That's $75 a contract. If you did 10 contracts, that's $750. I'm not saying that your account size should handle 10 contracts. We'll talk about that in a minute. But you have a defined risk, and the risk is easy to compute. All you're doing is subtracting the difference between the two strikes is $2.50, and then subtract the premium that you received from it. In this case, 75 cents, and our risk is $1.75. Now we have 17 days to expiration, and this is the important part about options, the way that we can use these effectively. Time decay works for us. As we get closer and closer into this, the time decay is wearing away. It's eroding the value of those options. And as long as it's above 355, as it gets closer and closer to it, all this cash starts to come into our pocket. And then at the end of it, we have a choice to either buy back the option and close it out in very small amounts, or if it's well above 355, let it expire worthless. Now in this case, we only put on 50% of our normal trade. Now the reason for that is that I was pretty sure it was going to go down some more. I expected a retracement back down. It had a large move up. Wouldn't be surprised if it retraced half of that move. That's kind of a normal thing. We move up, we pull back half of it. Usual movement in stocks or futures, options, anything. It's the way people work. So we developed our trade into a strategy, and we planned what's going to happen if it does this, does that. Well, we said if it moves down, hey, we're going to sell some other put spreads. And then we'll sell them to our maximum amount of risk that we normally take. And we'll either say, if it doesn't move down much, we'll sell some more of the same spreads, but maybe at a higher premium. If it moves down, it should be at a higher premium. Or we'll choose to sell them at a lower strike price. And then the second part, well, what if it moves up? Well, then we'll just go ahead and sell call spreads, and we're going to turn this into an iron condor. An iron condor, nothing fancy. It's just two spreads, one a put spread below and one call spread above. And what we want to try to do is stay between the two. And it increases our premium because we're selling two sides now, and by increasing our premium, it actually decreases our risk. How do you figure that? Because you've got two trades on. Well, it's simple. We had 75 cents for the one side. If we sell calls, we get another 75 cents off there. We have $1.50 now, and we only have a 2.5 maximum spread, so our risk is gone from $1.75 on down to $1. Now, money management is a very important portion of any trades that we look at. And larger accounts, I typically don't want people to risk more than 10% of their account at any one time, ever. It's very easy to recover from a 10% loss. It takes you 11% to make it back up. If you lost 50%, it takes you 100% to make it back up. You've all heard this before. It's nothing new. Well, we base a lot of our trades on a small account. We figure a small account, $5,000 total money that's in the account. Now, that doesn't mean it's risk money. That's the total amount that you have available. Now, a smaller account has, by definition, has to have a little bit more risk to it. So we'll say that we'll go to a maximum of 15%. Well, 15% of $5,000 is $750. So we're willing to risk $750 per trade. Now, we just put this trade on, and we have $350 that's risked so far. 175 times 2 is $350. So now what happened next? Well, Netflix closed what the heck happened here? How do we get back this? Okay, hold on. Okay, so let's go on through it. So Netflix the next day went down some more. And we thought, okay, what's going to happen? So it actually opened the next day at 362. It had a high of 367, a low of 353. Well, that's a big difference from where we sold. A low of 353. Oh, gosh, we sold 355s. We have a loss. Well, you won't have a loss until when? Until expiration. So we took a look at this and we said, okay, what else can we do here? So we said, I think it's going to go back up. Pretty sure it will. So I'm going to go ahead and take some risk on this now. We're not sitting there and just shooting this in the dark. It's not something that we're just gambling on. It is a risk management. So what we did now, I said it's down at 355, 353 low. So why don't we sell something down lower? And I'll sell a 345 put spread now. 342.5, 345. Means I sold the 345, I bought 342.5 for protection. Now this time, I'm receiving a little more premium, 85 cents. Yeah, not bad. Now my risk on this is $1.65. Now it's been 1 day more time decay, so I only have 16 days left. So once again, I sold 50% of my normal trade. So there's little accounts, the little 5K accounts that I'd risked $750. I sold 2 of the others and then 2 of these. And now I have a normal trade size on. Those 5K accounts have 4 contracts. The average premium is 80 cents or $80 per contract. They'll bring in $320. And by the way, we have about a 70% probability on this trade working. Now, that means that at the expiration, you have a 70% probability that it's going to be at or above there. Now, during the trade time, it's not unusual at all for the trade to actually go into the money, and if you were to close it out at that time, actually have a losing trade. That's not unusual at all. As a matter of fact, if it doesn't come down close to it, it means that you did not receive enough premium and you're taking too much risk. You'll see all the time people will refer to a 90% probability trades. And we can design those if you want it, or 95% probability. But you take so much risk. Let's say on a $5 spread and you had a 90% probability, you'd only get 50 cents worth of premium. So if you made all these trades, if you had 1 trade lose out of 10, you're at break even. If you had 2 trades, it's going to take you a long time to make it back up. So this average premium is 80 cents now. So on those 4 contracts, we have $320. And our risk now is reduced down to $1.70 or $680 per 4 contracts. Remember, $750 is the maximum we want to risk, so we're within our risk parameters here. I feel comfortable putting the trade on. My reasons are that I have fairly good probabilities, the way that Netflix has worked in the past, the directional move. We have 2 weeks to play with the trade. If it moves back a little bit, still expect it to move back up during that time. Now, what's our plan? We've done another trade, so we have to develop our strategy a little bit further. So it moves down. I'm going to wait for it to move back up some. I'm not going to panic if it moves down some. Why? Because I know the probability is that it can move down some more, but the probability says it will probably close up above where we are. Now, if it moves up, what are we going to do? Well, we're going to sell call spreads, turning those trades that we have into iron condors, and we're going to increase our premium, and we're going to do this only for 50% of the position. So we have 4 on now. If it goes up, some will put on 2 of the call spreads and turn half of it into iron condors. The other half we just have a put spread. Now, why would I do that? Because I'm looking, if it moves up higher, I'm going to sell additional call spreads at a higher premium or maybe at a higher strike price. So I've got all these planned out ahead of time. Now, as normal, what happens? Well, let's take a look at the risk profile. Netflix. Okay, if it goes to 355, we have our maximum profit that's there. Now, if we did all this at 1 trade, and we put on this 352.5, 355, we would have our maximum risk at 352.5. I mean, our maximum loss at 352.5. And our break-even point would be the 80 cents. Down below that, I forgot to put this on, the 80 cents we received our premium. So our break-even point would be 354.20. Now, what we've done by moving this other spread further to the left was taken the risk and moved it slightly down further to the left side. So now this other spread is 345 where we sold, and then 342.5. All of this premium we received here can go up to the upper one. So now I have additional premium, and I'm bringing my break-even point on down another 80 cents. So now I've moved my break-even point down. Let's see, I received 75 cents and 75 cents and 85 cents. So I'm moving it down $1.60. So my break-even point has come down quite a bit. Now, obviously, if it continues on down, we stay in this plateau between 345 and 352.5. It doesn't increase our loss. If we go below 345, it starts to increase our loss until we get to 342.5, and that's our maximum loss. And that would be exactly the same loss, total loss, if we did it all of the trades at one. So it just gives us an opportunity to reduce our risk and still make a profit. Now, as normal, what happens? Well, let's see, on the 24th, Netflix went on down more and goes down to 334.80. And guess what it does on the 25th? Well, it drops again to 322. Oh, heavens forbid, we have a loss. Well, yeah, you do have a loss if you were to close it out right now. And basically, on the 352.5, 355 contracts, you would have had a 65-cent loss. And on the other ones, 342.5, 345, so you'd have a 50-cent loss. So your average loss would be about 57.5 cents. That's only if you closed it that day. But the probability, we still have time working for us. The probability is that it'll go back up above us. And we'll make all of our profit. So am I worried about it? No. And there's a couple of reasons. Number one, our probabilities are up there. And we can develop an additional strategy on how to offset this possible loss. Well, what do we do now? Well, gosh, we have to plan for the way to reduce that risk and increase our premium. What we want to do is increase our premiums to the point where there is no risk at all, so that we'll say, instead of, well, what's our maximum loss we can make, what is the minimum profit we can make? So that's what we try to do next. So now, on Friday, now this is just a couple of days after the trade's on, we're at a loss. Everybody's worried. No, we're not really too worried at this time. So we're planning for what our next thing is. And it's going to be a directional trade for the next week. And we're going to plan it for late in the week. Now, didn't do a whole lot. Just simply say, hey, we'll do a directional trade if it hasn't moved up, and we'll adjust our trades and our premium accordingly. Now, the next Tuesday morning, I did a presentation early in the morning, and I refined the whole plan for a trade to trigger off on Thursday. It's Tuesday morning, and I'm setting up a trade for Thursday. Yes, exactly right. Now, why would I plan this for Thursday? Well, we're going to take advantage of this low extrinsic value. It just simply says, hey, I want to get this option as cheap as possible. And we're going to use the ones that expire that week. The next day they're worthless. And the big thing that we're using here is an average trading range of Netflix is 18 points. Well, if it moves 18 points in a day, that's average. Well, some days it's going to move less, some days it's going to move more. So let's simply say that half of the days, it may only move half that, 9 or 10 points. The other half, it might move, 25 or 30 points. And that's pretty well Netflix. So what I'm planning now is a trade where I can see a move of 10 points maybe. I don't care if this thing moves up. Don't care if it moves down. I prefer it to move up because I've got other trades up there that's part of the strategy that would make money if it do. But if it moves up, I'm going to buy an at-the-money call. Now, generally, with Netflix and it only has 1 day left, these calls, that trade would be worth about $3 to $5 per contract. If it moves down, instead of a call, we're going to buy a put. Same way, at the money or maybe one strike out of it, but very, very close to the money. Now, why do we do that? Well, we're planning on this 10-point move, and it's about 50% of that ATR, but we're doing it at the money because we have a delta of 50. Now, if you remember from earlier classes, a delta is simply the amount of movement in the option versus 1 point in the underlying. So if we have a delta of 50 and Netflix moves up 1 point, we get 50 cents. But because these expire tomorrow, as it moves more and more in the money and moves the way that we want it to, that delta will increase. With about a 10-point move, our delta's gone from 50 to about 70. So it simply says, if we have a 10-point move, we should be able to get 7 points worth of profit. Now, we have a stock that we know has volatility to it. Its average true range, or trading range, is 18 points. High probability it's going to move 10 points in a day. We still have another week left after this, so if it doesn't, we can look on Friday or we can look the next week. Now, we have to plan for our money. And how do we sit there and do a trade like this? Well, first thing is these small accounts. Remember, $750 for a normal trade. So, and they right now have $680 out of that. So what I'm trying to do is say if there's 4 contracts, I only need to have 1 contract on this directional trade to move that 10 points to be able to produce $700. And it's going to offset that risk of the 680 for the 4 spreads that we have out there. In other words, it's producing a risk-free trade, or basically it'd be $20 profit worth in here. Now, if somebody had more contracts, let's say they had 10 contracts, instead of 1 per 4, I'd say, maybe 3 contracts for each 10 if you have 10 contracts out there. And that way, if it works for you, you're getting a little bit more profit and all, too. You can afford to take a little bit more risk if you have large number of contracts, larger account size. But I'm limiting this risk on these small trades. Now, what happened? Thursday comes along, and we've set this trade up for the whole Tuesday morning. Haven't done a thing. It's Thursday morning. Netflix opens at 3:24:05, and it started up, and the markets went positive. The futures went positive. We saw things going up, so we said, okay, and I just simply put it out. Why don't we go ahead and buy the May 1? Remember, this is May week 1. It expires tomorrow. 327.5 call, and we're going to pay $3.50 for it. Well, that's our $3 to $5. That's okay. So we're risking $3.50 for those small accounts now. They have a risk now, total risk of $680 for the 4 spreads, and now we've added an additional $3.50 here if it goes down all the way. Don't plan to hold it that long. Our risk, our maximum risk on it that I felt was about $2. If it went down on us, we'd bail out of the trade, and we would risk $2. Okay, so what happened? Well, here's May the 1st, and what happened? Netflix went chug, and went on up to 345.69. Well, those May week 1s, the ones that expired on the 2nd of May, the next day, 327.5 calls, went as high as 1825. Now, I'm not going to sit here and tell you that I made all that profit. I did not. I had a plan, and my plan was basically, 10 points, it's time to bail. So took it a little bit further. We sold call for $11.80. Now, some of the folks stayed in it longer, some stayed in less. I mean, it's a little bit of everything, but this was the trade I had. Sold the call for $11.80 for $8.30 profit. Remember, $7 is what I needed to cover my cost. So now I have actually a profitable trade. The entire trade now, this whole strategy, the first put spread, the second put spread, and the call that's now closed out, I can't lose anything. The minimum I can make is $50 worth of profit, and the maximum is $370 worth of profit. So I have a trade that's out there, no risk. Hey, I like this. Okay, we got to extend our plan out. What's our next part of our strategy? Well, easy. If Netflix moves above 365, we're going to sell a call spread again. Just exactly the same thing. If it moves lower, we're going to repeat our same directional strategy that we did this week. Now, I would not sell additional put spreads. Why not? Because it already showed me that it had weakness and went down to just below 300, I think 299.80 or something. I can't remember exactly, but just below 300. So I don't want to sell spreads at 320 or whatever if it's going to break down to 300 and add additional risk. So I said, no, that part was out. So I have a trade on now that's a break even to a slight profit regardless of where it moves. But I'm going to see if I can't add some additional funds in here. So what happens? Well, over the next week, Netflix moved down to 315.21 on Wednesday. Now, planned exactly the same trade for Thursday. The same exact reasons why. We had 1 day left to expiration, so there was very little extrinsic value. We could buy a put or buy a call for a small amount, and at the money put or call would give us a delta of 50. If it moved 10 points, the delta would increase to 70, give us 7 points worth of return. Sounds familiar, huh? It worked before. Why shouldn't it work again? We still have the same average true range or average trading range, depending upon who you're working with, of that 18 points. 10 points is about half of it. Hey, this sounds good. So what actually happened? Well, Thursday morning, the day before my birthday, this was a little birthday present. So Netflix opened at 317.16, and it pulled back a little bit. And I'm waiting, and I'm saying, oh, okay, we might be doing some puts this time. But the rest of the market didn't indicate that. The rest of the market says, hey, we're looking up a little bit. So I gave it a couple of minutes, and I think we probably went to about 3 to 5 minutes into the cash trading day. The markets were positive. Netflix started back up, so we bought the 317.5 calls that expired the next day, May 9th. We paid $4.05 for those. Still between that $3 and $5, same type of range that we're talking about. So there's Netflix movement for the day. Gosh, went down as low as 314. Remember I said you had to pull back at the beginning, and then it came right back up. 314, and then it was as high as 335, something like that. There we go. 331.72 is the high. Now that option that we bought went as high as 1375. I would love to sit here and tell you that I sold mine at 1375. Yeah, no, I did not. Well, we did sell it for $11.90. That gave us $7.85 profit, along with the other profit we had. Now our entire trade has a minimum profit of $785 and a maximum profit of $1,155. Now that's if we don't add anything on in addition to this. So it expired the next day, and didn't look like we would be able to add any call spreads to it, so this pretty well looked like the trade. So what actually happened? Whoops. So actually what happened is that Netflix did not go up above our 355 or even the 345. It stayed down below that for the next day. But we took trades that were 2 losing trades and added 2 additional trades to the whole strategy and turned the whole thing into a profitable trade and came out $835 worth of profit and all on this. So what I'm trying to show you is move away from the old traditional buy or sell. So many people will buy a call, sell a call, buy a put, sell a put. Then they move into, the old covered call thing, which actually I can show you selling a naked put actually has a little less risk than buying a covered call, but we won't worry about that now. And then they'll move into spreads, but they'll put a spread on and they won't think about what they can do along with that spread. They'll either hold the spread and look and say, hey, are we going to make money or lose money? I have a defined risk trade. I can let it go to the end. I can go out and play golf or do anything at all that I want to. Or they'll sit there and panic if it goes against them and get out of the trade too early, and the trade will move right back to where the probability says it was, and they missed their full maximum profit. So start to think about how you can turn a trade into a strategy. And all this leads down to basically what I do with DTI, and that is mentoring a short-term options trading room. I refer to it as weekly options, but the trades are anywhere from intraday up to usually 3 weeks. Be the highest. We do some that'll be a little farther out than that, but most of those are relatively short-term. We're using a lot of weekly options on this. Sometimes, where a stock may not have weekly, so it will be a monthly option, but it'll be shorter term. The majority of the trades that we actually do are defined risk trades. They're spreads. They're put spreads, call spreads, whatever. They're the types of trades that we just talked about here. They don't all work like this one did to go down. Hopefully, we don't have to have as many adjustments on like that. But that'll give you a little idea. Now, within the first 2 weeks of June, we're going to have a trial. And this trial is interesting in that it is not just a trading room. What we do is, because I have people that come in here that have never traded more advanced trades. They may have never even traded options before. So we go through and spend an extensive amount of time and record some classes and all for them on basically just basic options. What's a put and what's a call? What's delta? We don't spend a whole lot of time on that, but it's all recorded there, and they can go back and play this. Show them how to go ahead and do the best purchase depending upon the particular type of trade. If you're looking for holding for a longer term, if you're looking for an intraday or whatever, we'll go through a lot on volatility. Volatility is probably one of the biggest things that most people never pay any attention to. One of the second biggest things that people don't pay attention to is open interest on options, and they'll pay very wide bid-ask spreads and don't understand why they lose money even though the trade works for them. So we go through a lot of that. And then we develop that more into spreads and buying spreads versus selling spreads and the higher probabilities and so forth. Then we'll go into taking those spreads, moving them into iron condors and into butterflies. And all this is shown on Thinkorswim. I do all the demonstrations on Thinkorswim, but you don't have to have Thinkorswim. I don't care what platform it is. As long as you're able to sell and buy spreads, I think you do need to be able to do better than just buying and selling a put or call. So just to let you know, I'm running a little shorter on time than I actually planned. I think we had 45 minutes, and I'm still sitting here with less time than I thought I would need. So that's basically running down what we have, and invite anyone to come in. The URL's at the bottom there, and this would be $99 for the first 2 weeks. These are the first 2 full weeks, not the first June, but the second, which will be Monday through the following Friday. But I'd like to invite everybody to do that. Any questions you have or anything, I would be glad to try to answer. Otherwise, I'll relinquish my time to anybody else. Okay, so I guess that will be it for the evening. Thank you very much for having me, and hopefully we'll see you again not too far in the future.